4,500 unusual options on ULTA Beauty. In this video, we're going to analyze what these options mean and how we are trading it. This just happened about an hour ago at 11:30, 11:29. It is now 12:28 p.m., May 12. So if we look at the charts on ULTA, you'll see that it reached a high of 556 and earnings is approaching on May 25. So keep that date in mind because we will be using that date as part of our trade. And so when we look at the June 16th, which is where these unusual options are at the 450 strike puts, we can kind of get an idea of how much they're worth, because you can see here this was paid at 480, 460, right? First it was being paid at the 29-minute 59-second, it was being paid for 460, and then it went up in price at 480 because of the excessive buying, more buying pressure, so it pushed it up. So 1 minute later at 11:30, it required 480 to purchase these puts. And so to get an idea of the value of that, for example, this 4,500 one multiplied by $480 per contract, that was $2.16 million of basically shorting ULTA. And when we look at the June 16th, you'll see the 450 is actually all the way over at the 14 delta. So that's quite unusual, very far actually out of the one standard deviation. You'll see the volume here, a total of 5,000 now at this 450 strike puts. Okay, so we can kind of take a look at that. It's right now going for a lot more now since ULTA has dropped. But this is what it looks like. The current price at 511. If it goes down on the x-axis, which is the price, it will be profitable. So here is the zero profit loss. Anything above is profit. Anything below is a loss. So this is quite unusual because this is quite far out. If we look at the charts, 450, we actually have to zoom out to see if we can find 450. That's all the way around here of last year, back in December 22, when it was trading at about 450. So that's quite interesting. Earnings is coming up, so let's take a look at the volatility, where we are also on volatility. We're at 37% IV percentile, implied volatility also 37. Okay, and so the way we are trading this is, because it is quite far out, the delta is very small. It's a less likely probability of happening. However, it could happen because we have earnings coming up. We bought the 455 strike puts, and then what we did was we sold the May 26th. This is the one right after earnings. So this is the closest one with the highest volatility. You'll see 45% here overall. And so we wanted to take advantage of that and sell the 450s over here at this expiration cycle. And so when you sell that, it costs $315 to put on this trade. This is a diagonal trade, and as you can see, when we analyze this and take this off, watch out the trade we have. This is a diagonal bearish trade because it will profit as the price goes down. It is above the zero line as the price goes towards the left on the x-axis here, and it is above the y for profit. Loss is here, so if it goes up, then there is that loss here, as you can see. And so that is our zero line here. Currently trading at 511 here. And so the reason why we like this trade is that it does reduce our risk. If it does go up, you'll see that the loss is not that great. But if it goes down, you'll see that we have quite a lot of profit we could be making. You'll see. You'll see from our Greeks, very nice positive theta here, and a positive vega, which is good for a trade before earnings because we expect this trade to increase in volatility as we approach earnings. We may take this trade off before earnings as well, and maybe change our trade setup based on where the price is right before earnings. And so that's what we like about this trade. It also is that negative delta. Same with the unusual options. When we look at the unusual options, though, we don't like it as much because of the negative 19 theta. And that is what's concerning, is that if it doesn't move down soon in price, then we could be losing value on our options with this theta decay. So that's why we don't like it. And our trade only costs $315. The current price of these 450 puts are already at $520. So you can almost buy two of these to almost for one of those already, and get that same amount of delta, because you see here that this delta is negative 13 and just one of our trades is negative 6. So if you just get two of them, you'll have negative 12, which is very close to that negative 13 already. And you get the benefit of the positive theta. So that is also why we like our diagonal bearish trade on this. To recap, will ULTA break below this support? Because there is a support here. Right here is that level, about $500. It is that psychological whole number at $5. It would have to break that to get down to 450. And of course we have earnings, so anything can happen. So hopefully you learned something. If you enjoyed this video, please smash that like button and subscribe if you haven't, and comment below on what you think will happen to ULTA and why these put options were being bought. What do you think is happening here? Very curious to know what everyone thinks. Thank you all, and good luck.